Hi, I'm Keith McCullough. Welcome back. Today I want to talk about a very important market risk factor, which is, of course, volume. Not everybody talks about volume because, again, you'd have to do your homework, a little algebra, a little overlay, a little trend work. But again, volume, big time factor that is signaling the nasty all of a sudden as we test the all-time highs in the U.S. stock market, which, by the way, has never happened before. So anyone who tells you that there's a precedent for this is making it up. Now, first, let's just go to the wood. Let's just look at a picture. So again, this is in the chart of the day today. Our chart of the day is in the early look, which I write myself every morning. And if I'm taking a day off, somebody else might write it. But the point is that the chart of the day is in there. And in the picture, you can see quite simply the last month on market up days, you basically don't have any volume. You can see the last 5 days versus the average, and we're using 1 month. And again, the market's been straight up for 5 days. The volume's been down 14% versus the 1 month average. Now, let's just dig into some bullet points to show you what that looks like. Volume on down days is up. It's up, okay? Volume on down days is up. So again, we're trying to show you some conviction here. That's where the bodies lie. Up 8% versus the 1 month average. Volume on up days, again, down 5%, okay? So on the up days, there's no volume. That's down 5% versus the 1 month average. And yesterday's volume, never mind the last 5 days, was down 18% on the up day. So again, there was no volume. That was one of the worst volume days of the year. So again, there's some real interesting developments here, and this is why we call it vanishing volume. Now, some people may take issue with this. Some people might say, well, Keith, you know, the market's been going up on no volume for 5 years. First of all, that's a totally qualitative comment. It doesn't consider the relative change, nor the slope or the rate of change within the change. And again, that's just not how we roll. But I'm also making the point relative to the unprecedented all-time highs. So again, it's a really important spot. Now, as a predictive signal, why do we use the three-factor model instead of a one-factor moving monkey? You know, I call the 50-day, everybody knows this, but the point is that I call the 50-day moving average and the 200-day moving average moving monkeys because I used to be a monkey. I used to use that. A one-factor model, my 6-year-old can dial it up with Fisher Price or Yahoo Finance. That doesn't work. So let's just get a little bit evolutionary here, and let's go with a three-factor model. Price, volume, volatility. There's 3 scenarios. Scenario number 1, price is up, volume's accelerating, and implied volatility, which you can ask most moving monkeys, they don't even know what that means, is falling. That is a bullish setup. Second scenario, this is not good. Not good for a monkey or me. Price down, volume accelerating, and implied volatility is rising. That's bad. It's bearish. Third scenario, price is up on down volume and volatility is not really changing from a signaling perspective. That's bad too. So again, that's what we've had in the last 5 days. That's my point. That's the point. It's not a good signal if you're thinking about this on a three-factor composite signal basis. If you're just looking at price, you have no idea how bad you're going to get burnt, by the way, if this were to change. So again, watch this signal very closely. It matters. It has always mattered in my model. If you have any questions on that, I'm at Keith McCullough. That's my Twitter handle.